Great. I'll go ahead and get us started. Thank you everyone for joining in the room on Zoom. We're very excited to have Tom Anderson here. Tom Anderson is the founder of Anasova. For those of you that have been tracking along since the beginning of the year, Anasova is one of the newest members of the Vested Ventures portfolio. We're very excited to have Anasova as a part of the Ventures team. Anasova, if I could just do like a very quick one, which Tom's then going to correct me, basically helps connect people with financial planning and finds a financial planning tool for everybody. They operate the website freefinancialplan.com, and you've got a number of agreements in place, affiliated market agreements with some of the fintech companies that we all know and love, including UNest, which is another Vested Ventures portfolio company. So Tom, thank you for joining us. I know you're gonna have a conversation with Karen, so we can learn a little bit more about Anasova. And I invite everyone on the call in the webinar, if you have any questions, please let us know. We'll be sure to have Tom answer those.
Thanks for having me. Really appreciate it. Hello to everybody there.
Okay, thanks so much for being here, Tom.
Absolutely.
Eric obviously talked about what Anasova does. Can you give us a little bit more history of why you started Anasova? And I guess if you want to expand on anything Eric already said.
Yeah, so it's actually a really simple company and a really simple concept. Most people don't have a financial plan. And so, people will say all the time, and I think you guys have a lot of people who use this information for many different things, but money is the #1 cause of stress. But if you think about it, billions of dollars have been invested in financial services and financial technology over the past 10 years. Our data actually shows that stress is increasing, not decreasing, despite the number of tools that are coming out. And so if we're 13 years into a bull market, you have record low interest rates, you have all of these new apps and services, but stress is rising. It just doesn't really make a lot of intuitive sense. And so we really think that the concept is simple. People don't have a plan. And when you have a plan, stress automatically falls. And so that's our simple mission is we think everybody should have access to free, high quality financial plans. And that as a result, the long-term financial stress will no longer be the #1 cause of stress.
That's smart. Can you tell us a little bit about your background and why you came up with this idea?
Yep. So my background, the short version of long story, born and raised in Cedar Rapids, Iowa, went to school in St. Louis, came out and lived in New York City, worked in investment banking, lived just a few blocks down the road here.
Nice.
Yeah, it was a great time. And then I moved back to Iowa to partner with my mother as a financial advisor. So I spent about 20 years as an advisor. Ended up kind of having a dual career track. I was at Merrill Lynch, and then I followed some good friends over to Morgan Stanley, and I know that you guys all have a close relationship with Morgan Stanley. But I started coaching and training other financial advisors. So I wrote a book called The Value of Debt. Morgan Stanley bought a lot of copies of it, so it got a lot of accolades. And then that led to releasing kind of 3 other books about managing both sides of the balance sheet. Left Morgan to start a financial services technology company called Supernova. It's basically a lending technology company. Sold a big portion of my stake in that in 2018, kind of transitioned in 19, came up with this idea in 20 and found you guys in 21.
Nice.
There you go.
Nice. So how are you different from any other financial planning tools, free or otherwise?
Yeah, it's a great question. So I think that there are 3 main differences with the way that we approach financial planning. And so my goal today is to try to give you guys all actionable things that you can be thinking about for yourself, as well as if you're kind of reaching out to your network and things like that. But the first thing that we do is we really focus on ranges. So a lot of financial plans focus on a specific number. You need $2,622,000 in order to retire. We just don't believe in that type of an approach. People retire with many different lifestyles all the time. So we say you need between $1 and $3 million, just like a range, right?
Yeah.
But a lot of people just don't even know what the range looks like. So we focus on ranges, and then by just that being your broad target, I think it helps people to be like, okay, I got it. And the more you use a range, the higher the probability that you'll be within that range, right? Because the lower end is more attainable, and I think that makes people feel that the plan is achievable, especially because a lot of people aren't on track. If you feel like you at least hit the lower bound, things might work out. The other thing that we do that is fundamentally different is we talk about both sides of the balance sheet. So what you should be doing with your debt. In that case, what we do is all debt over 8%. So like credit card debt at 20%, the plan's going to say right away, we want that paid off. But we put debt in different categories. And so good debt, like maybe a low cost student loan, maybe a mortgage at 3%, you don't want to rush in to pay that down. And so if you have bad debt, your plan will only talk about paying down that debt. If you have good debt and you've eliminated your bad debt, then you actually get different pages in the plan, kind of coaching you on whether or not you should pay that down and why. And it does the math on, ultimately at some point in your life, it'll tell you when you should pay it down and when you shouldn't. And so that's a interesting part. The final part that makes us different is that we actually believe in, we provide limited investment advice, but our advice is unique. A lot of people invest based off of their risk tolerance. That's a traditional approach. So you're a moderate investor and you're a conservative and you're aggressive. What we actually find is that most people just don't have a big enough base of assets. And so we say, what you need to do in the near term is build a low cost using like ETFs, just extremely broadly diversified, low cost ETFs, build a base first. And then once you build that base, you can then look to other asset classes. And those small shifts and ideas lead to huge changes in kind of the outcome, right? If you're young, why would you need to build that base first? And so we can help you quantify what that base looks like.
Nice. And then do you then help people create a plan for spending? Let's say they want to buy a house or they want to save, things like that.
Great question. Not so much. So our plan is primarily focused on, so ultimately what we want, the other things that make us unique, our plans are fast, free, and anonymous.
Yeah.
And so the average person only spends about 6 minutes building their plan. So it really is focused on the big goal of financial independence. So what's it look like for retirement? And so ultimately we want to release more modules to kind of talk about like all of the other things that one can be planning for, but what we're really known for right now is just what's it look like for me to get to long-term financial independence, retirement planning.
That's great. That's great. So it would lead me to believe that you're targeting older individuals, or who are you targeting primarily with this product?
Great question. So because of the nature of the website and the type that anyone can essentially access it, we have to kind of conform to a lot of different personas,
Yes.
which is one of the difficult parts of coding it, because all sorts of different people, use it. Our average user is about 47 years old with a standard deviation of around 14. So these are typically people that are 30 to 60. It's not people in their 20s. I mean, they do come in. Our average person has a net worth around $500,000. They tend to have about $300,000 of that in their retirement plans. $200,000 is in either home equity or cash. They have limited investment assets that they could actually move to an advisor. My former firm and your client, Morgan Stanley, is fabulous. We actually coach and train everyone to get rid of those clients, right? Because they're moving, up market.
Yeah.
And so there's this giant demographic. What a terrible time to have $250,000, right? It's because nobody is really catering to the advice that you need right now. You don't get it through the robos. You aren't getting it through full service advisors. You aren't getting it. So there's this big gap of that kind of 50,000 to 2 million space. And that's where our plans just consistently keep coming in that range.
Great. So what do you hope to do with the money you're getting from Vested Ventures?
So our original focus was that we were thought that this was going to be direct to consumer, and we still have a lot of direct to consumer activity every day in our free financial plan website. But we have had actually a lot of interest, and we just signed a fabulous relationship with a very large financial technology company to white label our plans.
That's amazing.
And so we're really, really excited about it. The challenge with white labeling is, so they basically want the same plan and the same system. But what you have to avoid is you can't just copy it. So you want to be basically able to customize it, or you end up with a bunch of different instances. And so we're basically investing in the product right now to productize it, so that more people can say, well, I want that too. And I'm just dropping in kind of the white label. I want my logo here, and I want these questions here, and I want to customize this piece. So we're taking what was our direct to consumer product, and we're productizing it. And we think that that's already having some really nice success.
That's great. So how does Anasova make money then?
Great question. So everyone here is like, it's fast, it's free, and it's how does that end together? So the direct answer is it's an advertising model. So if you think about things like, Facebook and Google have been very successful monetizing advertising. And so we monetize advertising in a similar way. When you are, as you guys no, and I'm talking to the experts, so you guys can help coach me on how to position some of these things. But in display ads, I'm on a web page looking at content, and ads are being put, which may or may not be relative to me, but I'm there primarily to read, the article, right? In search, if I say, I need a plumber, then chances are high that you need a plumber. And so search was able to engage people at a much higher level. When you take the time to run a financial plan, and then you take the time to read it, if we say, you should pay off your bad debt, here's a tool that can help you do it. 1 in 5 people want to take action, actually click on a link to learn more. And so we put together it's basically an app store of best in class solutions. So I want to take care of my kids. I want to look at UNEST. I want to, I like this idea of building up low cost mutual funds. How do I do that? And I can click, and you can do it commission free through a SoFi or an M1, or you're not monitoring your credit. So use Credit Karma. These are 70% of our users don't have a will. Click on Trust and Will, right? So, and I would actually tell each one of you to think about that, right? Like, we think that getting a will will be so difficult, but the second you get one in place, then you check that off your list and you're kind of done for 5 years, right? You automatically feel better. You feel like you're making progress. So we monetize those as performance marketing, essentially affiliate links. We share that revenue with our white label firms. And when we do it on our direct to consumer, it's a wider spread. And then when it's through our partners, we essentially pay out and we keep the difference.
Makes sense. So what are your goals for 2022 and 2023?
Great question. So from here, we have a nice foundation. So it's almost worth kind of just backing up to look at a little bit of history. So we had the idea in 2020. We then had to get in 2020 our first 1,000 plans to go through the system, and that's harder than you can kind of imagine to get the first. And you learn a lot just by plans coming through. So then in 2021 we had 20,000 activities, but we were just kind of monitoring and testing what's working with people, and we think we've really kind of refined a lot of that. So we want to take kind of the best in class and put it all together in this kind of common productized solution. This year, we want to do 2 things: continue to improve our direct-to-consumer channel, where we're seeing our acquisition costs fall dramatically, successfully roll out to our white label partner, which is a tremendous opportunity for all of us. We should come back to and talk about them more.
Okay.
And then the third one would be to add, with 1 to 3 more white label type partners. So as you have different companies in your ecosystem, these don't have to be giant enterprises, but people who would like to offer financial plans. It can be companies to their employees. It can be AARP to their members, right? It can be any type of organization that's looking to have a white label financial plan for their members, employees, or kind of constituents. It's really powerful at driving action. So just sign up a couple clients.
That's great. So tell me about some success stories or some kind of anecdotal testimonials that you've heard from customers, like, oh, I didn't have a will and I got made one, and this helped me do X, Y, and Z. Yeah.
So one of my favorite things. So the interesting thing is that we run plans 24/7, 365. Almost once every 15 minutes, a plan is going through the system, and more people like to run plans, on the weekend than they do during the week. So we're busy to get a lot of the off hours. And this weekend we got so much feedback coming into the system. I was like, I wasn't even, like, a lot of times people don't fill out the surveys, but one said, God bless you. I have always been wanted a service like this. How nice I didn't have to talk to a person. Right? They don't want to. Yeah,
No one wants to talk.
Right. I don't want to talk to a person. I got really good information. It was free. It was what you told me it was going to be. And so, yeah, we cataloged all of our responses. And if any of you would ever like to see the responses or see the data, we'd be really happy to share it. But users really like the input process because it's fast and easy. We'd love to hear your feedback. So try a plan. It is anonymous, right? Don't put in your email and it's 100% anonymous. Put it in and it's just emailed to you. But yeah, really neat feedback coming in from users, which makes us very excited.
That's great. And what is your most popular affiliate? I guess, are people looking for wills most? Are they looking for their credit score? What do they click on the most?
That is a it depends a little bit on the persona. So for people who have credit card debt, so about 80% of our users borrow money. And within those who borrow money, about 50% of them have credit card debt. And so a lot of people are just accustomed to carrying, like I get used to carrying $4,000 of credit card debt, even though they have investments and cash, they're paying 20% on that credit card debt. And so the plan is just like, well, pay that off. So when we show them ads that are customized to their situation on how to pay that off, either like here's an app that can help you or a line of credit. If you have credit card debt and you click on one of those links, the click-through rates are as high as 60% in some of the products. It's
Wow.
crazy.
That's unbelievable.
So that one is just really, really, really high. So personal loan refinancing click-through rates are off the charts. Beyond that, it's an interesting mix. Wills are very popular. And I would say credit monitoring is popular as a simple click-through.
Right.
I should have credit monitoring. It's just kind of like no-brainer type stuff. Those are probably the top three, but it's actually pretty widely dispersed between about 20 different partners. It's interesting.
Great.
Yeah.
Those are all the questions I have. Does anybody else in the room have a question?
Yeah, I had a question. I just wanted to know, how do you build like trust in your platform when people, I know there's no email, but like, it's still financial services, it's still like money, and you're talking about like hundreds of thousands of dollars. Like, how do you build trust on a site? And when you were building your, platform in the last couple of years, especially when there's so many other, brands and tech companies out there?
Yeah, that's a great question. And as you go through it, so we need to have trust with our users. And so we value your feedback in terms of ways that we can, be building more trust. One of the things that we discovered is we don't need exact numbers to give what we think is really high quality advice. And so a lot of the financial apps right now want to pull in your real-time
they wanna
data
connect.
using login from other places.
Yeah.
We don't do any of that. So we ask you with a slider, how much do you keep in your checking account? And what we're really looking for is it $200, $2,000, or $20,000.
Yeah.
Right? And we don't care where it is. We don't ask you where it is. We don't ask you, we ask you how much do you have in investment assets overall, like not even by account, not even where you have it. So we ask big picture questions. And then based on those, we think that you're comfortable answering them as our hypothesis, because like, I get it, you can't identify me through these things. So any gate that you put toward more specific information, people don't want to share with you. But
Yeah.
we found we don't need to ask
That makes
those
sense.
things.
So do you see like a Nerd Wallet as like a competitor?
I think that's fair. It's a little bit of a different thing, because the problem with NerdWallet does a lot of great things, but I have to go to NerdWallet and know what I'm looking for in order to figure something out.
Yeah.
And the problem in personal finance is most people don't know what they're supposed to go to NerdWallet to search.
Yeah.
I don't know where to get started. With us, you just tell us about you, and then you get a customized plan, and it says these are things that you should consider. Then you're clicking on things that you find are relevant to you.
Yeah. Okay.
To kind of reverse the process.
Very helpful.
It seems so logical. It's hard to believe that nobody came up with it before.
I
That didn't
know, it's
exist
crazy.
already,
Yeah.
right?
Yeah. Part of it is that, some of the technology would have been harder to create like a plain English financial plan before. So, but I don't know why these things aren't around.
No, but it
Yeah.
exists now.
It
That's all
exists
that
now.
counts.
That's what it counts. Exactly.
The model was different. That's why.
Model's different.
Right, like
Yeah.
it was like if the free financial plan system existed, it was attached to a service.
Right.
So
That's
yeah,
it.
come to my financial service, I'll give you a financial plan, and then what do you know, all the recommendations lead back to buying something from me.
Right.
Yeah.
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 That's exactly what the planning process was. It was used to sell products by advisors, right?
Yeah.
And the neat thing, instead of it being an advisor selling products, just here's different things that are apps for you to consider, right? Like a Credit Karma, or check out an Experian, or use a Tally, use an Upgrade, use a UNest, you have kids, use a Greenlight debit card. These are just, you can pick and choose from the universe.
Makes sense. Does anybody else in the audience over Zoom have questions?
Go
Yeah,
ahead.
yeah.
Go, please.
Yeah, so how do you build the models of like things are changing, markets change, assets change? So is there a process that you're updating this with? Are you working with like economists? I mean, obviously you're a financial expert, so like, but what does that process look like?
Great question. So there is so the way the system is designed is there's an input layer, and that's dynamic. So it runs through a series of questions that get filtered. And so if you are 22, we're going to ask you different questions than if you are retired. And so what happens is, so kind of like a financial advisor has a shelf of questions that they're going to ask people. So as you change in your life, you're going to get different questions that are asked to you. So that's going to be one aspect of where the dynamic part comes in. It doesn't exactly respond to market conditions, but it does respond to changes in your life. And then when you say you're married, you're going to get, or you have kids, you'll get one type of a thing versus if you say you're single, then it asks you different questions, kind of depending on those things. That then goes through a formula layer, and then the formula layer goes into an output layer. As your life changes, so if you have credit card debt, you'll get one type of output pages. If you don't have credit card debt, you'll get different output pages. If you have no debt, you'll get different pages yet. So as you build up more assets or pay down debt or change behavior in your life, the rest of the plan is essentially dynamic and responding. The portfolio aspect is we did have a part where we're giving a little bit more investment guidance. And essentially what we've done instead is we calculate what we think is the minimum amount that you need in equities to retire. And so our basic answer is until you build up that base in equities, nothing else matters.
Yeah.
There's nothing to talk about. You don't need to worry about anything in the world. So there's nothing to worry about, which is a pretty simple approach, but it's been interesting for the people who like to really dork out on it. They're like, I can't do better than that.
No, I think that's great because like, I mean, I they have tools and the questions that they ask, I think kind of self-select people out of the process that need that education. So like, especially with like the risk tolerance, like, I mean, how do you answer that question if you don't already have, if you're not already investing? I think people sort of,
That's exactly right. If I have $20 million, then I can choose to be conservative, or I can be moderate, or I can be aggressive. Like your risk tolerance, it matters for how you're going to invest your money. But if you don't have, $500,000 saved up and you want to retire, then it's a completely different thing. And you don't know, like, so the answer that people will say is, I'm conservative and I want a 10% return. I know that we tested it, right? Like I'm conservative and I want a really big, and I want to work for a short period of time, have a lot of money, and be a conservative investor. Do that.
As a venture capitalist, if you can create that company, you're going to be very successful.
Well, we can tell you people that world doesn't exist. So
I resonated with the idea that you're saying that, a lot of our clients represent only people who are like 2 million, assets or more, right?
Right.
Less than 2 million, don't even talk to us,
Right.
right? Never even thought about like, that's such a huge range of money that people can't find like someone for advice, right?
Right.
Whether it's 250 or like $1 million, those people are kind of lost in the ether.
So think about what you're actually saying to the next level. So if you work with a lot of the best in class financial firms. So as best in class advisors keep moving up market, then what you really are getting in that space is a lot of the C team. That's just so then those are people who are then much more likely to try to sell you than because they're trying to earn a living and get the most money that they can from the client, rather than if you're really successful advisors that work with high net worth people don't actually sell because it will work out, right? If you're going to move $20 million to me, I'm going to get paid somehow, right?
Yeah.
I don't have to,
So
I don't have to be, but when you're in that lower space, it is still a world of high pressure sales because from a lower quality of advisor, there's a reason that they're in that space, and it's a time intensive process, and you have to talk to them and they ask you all these questions, and then they present the plan, and then they sell you all these products, and it's just
and they get a bad rep now.
Right.
Yeah.
Right.
Yeah, they all have a bad rep.
Right.
Sorry, go ahead, Dan.
Yes, one question for me. Would you just opine for a second on the current state of the market? Obviously, equities. Oh. Hello. Expect to be on the camera, so my laptop away. Equity, until like the last couple of weeks, equities have been trading at all-time highs. We are very long into a bull cycle with a lot of conversation with inflation risk and Fed tightening, of a different market, entering into a different market. Any thoughts on that generally? And then what do you think about for your business as if the next 2 or 3 years kind of look very different from the last couple of years?
Yeah, so that's a great question. And I think that so many people like to look backwards and then they take that and create a simple heuristic to apply things, forward. Stocks have averaged this for the past 30 years, and therefore they will average that for the next 30, or bonds have done this, and therefore they will, do that. And I don't think any of that will be the case. So right now we have generational highs in terms of where the stock market is trading. We have generational lows in terms of where interest rates are. Almost everything is at record high prices: stocks, bonds, commodities, oil, gold. You pick it. Everything is near these all-time highs. And so when we look forward, I think that look, when interest rates rise, the price of bonds goes down, and so that's just the mathematical fact. And so it's going to be hard to average big returns out of bonds. And at the same time, what follows bull markets is bear markets. And while we like to say the average is a 30% correction, last 2 that we've seen were 50% corrections. So I think that from here, 50% corrections need to be in base case scenarios with very difficult returns in bonds for a long period of time. And when we look at the inflationary risks that are all around us, I think that I'm going to get inflation plus a positive spread is going to be extremely difficult. So if people's financial stress is high after this past 13 years, and we're now about to come into this next period, I can't imagine that, employment is back in strong shape. I mean, it's amazing how real estate prices are high. It's just everything is great right now. So if things are like, what follows this is pain. That's I don't know when, but there is pain in our future, and that's I think on a pretty global scale. Surprised we're not there yet.
But you started a financial company. What, you are not a stupid person, so you know the pain follows, and yet you willingly last year, and we invested in a company that would benefit from an environment where everyone wants to get it, so everyone's thinking about investment. You talked about what the base case was for the wider market. What's the base case for Anasova? What are you thinking? You must have known about this when you started the company. So what are the upsides to the environment, to the pain that you're describing for yourself and for the company?
Great question. I think that in a year like last year, who needs a financial plan or financial advice? I can buy GameStop and Bitcoin, and my life is easy. This was the same thing in 2000. People didn't need financial advice, and people definitely didn't need it in 2007. All you have to do is buy housing. So,
5 houses if you can.
5 if you can.
Yeah, exactly.
Lever and press them all. The hypothesis is that when a correction comes, demand for advice goes up, not down. It's easy in bull markets to just get everything right, and every single thing is going your way. When things are bad, people need advice.
Yeah, like now.
And you need advice more broadly. So the most important thing is, while we do have an investment advice component to it, we give you a range on insurance. For example, we say we think that you need between $250,000 and $1 million of insurance, and then we say term is what we find best. It's incredible how few of people are within that range. They tend to either be way below it or way over it. They don't have a will. They're not monitoring just these basic things outside of the investment category. Similarly, a lot of people are savings, but as my My 14-year-old looked at it and he put his finger on it. He said, Dad, only 7% of people are saving what they should be saving, right? Because if you kind of think about like a rule of thumb is you should save 20%, 93% of people don't save 20% of their money. They save less, they save more. Most, of course, save much less than that.
Yeah.
Right? And so all of these things matter, right? And so in the next time the world falls apart, you need more advice, not less, to make these ends meet.
I think advice too being broad, like you've mentioned wills a number of times, you just mentioned insurance, credit monitoring. I think that to me is, to Dan's question about base case, is exactly it. Like you don't know where, when things go bad, you don't necessarily know where your personal shock is going to come.
Right.
Right. And so it's making sure that you've got those bases covered. Like what does credit monitoring mean? You know, when you don't have much in debt right now, and you have a lot of savings. We saw that through the pandemic. People saved a lot of money. So like, well, why do I need credit monitoring? I'm not going to have a credit card. Like, well, we're not right now.
Right.
But what are you going to do next, year? Who knows? Right. And like, that's when those things become important.
Yeah, very, very much so. Very much so. Yeah, I think the demand for advice and quality advice goes up when things are off track.
So do you recommend that people continually come back to the site and redo their financial plan as their circumstances change? Whether they pay down their credit card debt or they lost their job or other things like that?
Yeah, so the traditional rule of thumb is that, a plan should be updated quarterly.
Okay.
And I like that view, and that's our kind of, parting line, and it makes a lot of sense because if you just kind of look at things in those short-term periods. What actually turns out, the neat thing about personal finance is it's not like going to the gym that you have to always do to stay on top of it. I mean, if you actually kind of get like 6 things done on your list and you kind of gradually start to right the ship, you're already like way better. If you have the right amount of term insurance, you're monitoring your credit, you have a will, and you're saving, between 10 and 20% of your income, things will work out, right? And you don't have credit card debt. That's about it, right? But, so it will continually guide you to keep doing each one of those. But once you get like the big things checked off, you can update it once a year, It doesn't have to be that hard.
I think what I really appreciate, and maybe a challenge, an interesting marketing question for you, is how do you make the basic stuff sexy?
Right.
Because essentially when we keep asking you about these things, you're like, it's like 3 things, or
Right.
4 things, or 5 things, right?
Right.
Or 1 thing. People don't want that. It's the same thing as like I think about working out, right?
Right.
Working out is like, how do you lose weight? You burn more calories than you consume. It's really very simple.
That's exactly
Every week there's 5 different magazines, there's 20 different sites that talk about the latest eating trends or how the celebrities do. People love complexity. They find that very sexy, and they don't actually like simplicity.
Yeah.
They don't really, they want to find, there needs to be something else, something, can't just be that I have to consume fewer calories than I burn. There must be some other
I think
thing.
that's
I just eat
exactly
potatoes.
right.
Or like this week it's just all salads or broths or whatever it is,
Right.
right? So, essentially when I hear you talk, it keeps, this sort of like both sides of the ledger, like what debt, like very, very, very basic things. How do you intend to how do you square that with kind of the human instinct to kind of want to make things more complicated, want to make things sexier?
I love the question and I don't know the answer. And I do think it is a challenge, and that's where we can use, we look at this as a partnership.
Yeah.
There is no doubt that the industry is massively overcomplicating personal finance over and over and over again. I don't know why. It really is. And so that is a challenge is we are not making it very sexy. We're not making it very detailed. We're not focused on really specific numbers. It's simple, broad ranges, get the basics right, and your life works out. And it's not very sexy. And so
I think we do tend to blame the financial industry for that overcomplication. But if you look at the workout or the healthcare industry, the wellness industry, consumers also have to take some responsibility for that overcomplication, because we as consumers, I know I do too, seem to be allergic to very, very simple instructions.
we are, and it kind of comes from both sides. I mean, if a financial advisor said to a person, all you need to do, there's more than 20 years until you're going to retire. So, if you have more than 20 years until you're going to retire and we come into a bear market, that's a blessing because you're buying more along the way. So, but if I just said to you, keep buying low-cost ETFs, commission-free, and then I'm not gonna make any money from that advice,
Yeah.
right? And so the industry overcomplicates it because they can't monetize it.
Yeah.
And they try to convince you that you need to do all of these other things, but I think people also believe, well, money has to be complicated, but it isn't, and it doesn't. It's really amazing, but it's also incredible. We have a great data site that we can show you, but very few people just get the 4 kind of basic things right. Don't have credit card debt, save at least 10% of your income, build a base of equities first, keep your good debt. That's it. Have a will and term life insurance, monitor your credit. Done.
It sounds easy when you say it that way.
This is somebody that's written financial books. It comes through, right? Like, no, there's a whole chapter on each of these things. That's it, buy the book.
Right.
It's like a book tour, yeah.
I think there's something though about financial literacy, and so this is what a little bit of what we were talking about this morning in our editorial meeting. So interesting about the diet thing. I think you're kind of dealing with this audience that doesn't, again, they think it's so complicated and they don't like know the linguistics of personal finance enough to like know that a repackaged like simplicity already exists. For example, like, I mean, if you created a diet that was like be sexy in 3 months diet, and it literally was like every meal you write your calories and then you like look at your Apple Watch and you just make that number be more than that number, like repackaging it in that way. Like, I don't know that there's enough people that know enough about biology to know that that's like, that's just life. That's like anatomy.
Right.
So, I mean, to your point, Dan, I think you can like make it sexy. Yeah.
But I think that it also goes back to this point, right, about, I know we're supposed to be asking you the questions. But,
No,
I think it does.
it's
That's
collaboration.
good.
You
Exactly.
say this thing about like I'm risk averse, but I also want to make 20%, right? And
Right.
so in many ways, you can't get sexy in 3 months. If you did what I recommended, it would take you about 2 or 3 years. And most people don't want to wait 2 or 3
Yes.
years to get the body of their dreams, and they don't want to make the hard choices that it take. I certainly got done. I mean, to get the body of their dreams in 2 to 3 years. We all want to know how I go from wherever this is to an Adonis in time for this summer. So that, I think that drives our search. And it's the same with the meme stocks, with crypto, with these other things, which may be distractions in essence from your very core, very bland almost, very sort of, it's the equivalent of like, yes, having a salad every now and again and lifting some weights.
I think the one way you can do it, and this is not a question, this is now like solution oriented, which is you play the other side of Robinhood and you like start running ads like burned by Robinhood. It's like get people like there. What are all these like meme stalkers that are now like quoting in the Wall Street Journal? Like, yeah, exactly.
No, like, this is a terrible idea.
I quit my job and now I'm going back to do something I hate. Like, it's like
Right.
there's a segment inside of that.
There
And
is.
yeah, where you're enticing them. It's like, don't get burned next time, right? Like, let's
Right.
look at some of these things. Like, yeah, I think you could actually play the fear side of this equation.
We talked
Start
about
a
this
Reddit
this
group.
morning in our editorial meeting. Is that
A Reddit
that
group.
what Robinhood has done is damaging. I think a lot of people have done is they've blurred the line between trading and investing. And I think
100%.
they
Yeah.
frame themselves as an investment platform, but
Right.
they are really a trading platform. And many what we used to think of as trading. I was just telling Bean, my Uber driver this morning had a big iPad and he was day trading
Oh
while
my God.
driving his Uber.
He needs more life insurance.
Yes.
That's a recommendation.
But he at least would call what he does trading. But I think a lot of people think of that as investing, which is the opposite.
And what is amazing is that, so there's multiple Nobel Prizes that that you will not statistically be able to trade that successfully. And it all ends, the story goes the exact same way. It works and then it doesn't, and you lose it, and you had to quit your job and you're back at it. It's not possible. The city is based on the fact that it's not possible. And so that all of these people are out there day trading and they're getting this message that yes, you can get rich quick, or you can do these, and it's I don't know. I like the idea of burned by Robinhood. I like the idea of advertising into it. Channeling what you're saying, what we need to be able to do is the ideas are so simple. and you don't have to update your plan as often as you want, but we do need people to take action. That's how we get paid.
Mm.
And so driving people, like the difference between, so if 1 in 5 click on an ad, that's great. But from there to completion, it's only about 1 in 5 again. So 1 in 30 plans, somebody actually does something, which is off the charts compared to like Google and a lot of other things. But we need that to be like 1 in 20, 1 in 10, and we want you to take 3 steps. We don't want you to just do 1. And so how we get that, we don't have the answers to those, but it needs to be something sexier, like how to do it. I don't know the answer to it.
Paris Hilton could ask you the questions. I don't know.
No, bad idea, bad idea. Bad idea.
Well, now that you mention it.
Do you see like a lot of your like affiliates being like competitive? Like, there's like maybe like 4 lenders want to be like Upgrade, SoFi, and like, the whatever many that there are. Like, how do you manage like which lender to recommend? Like, is it by interest rates or is it just by?
Great question. So there's a short, medium, and long-term vision with it. And so right now, the ads that you get are products that we anticipate are good matches for you and you'll qualify for. So kind of like how Credit Karma leverages their credit information that you have. We ask you a self-reported what your credit score is. And so then based on that, we'll surface different things to you that we think are going to be a good fit. And we'll give you one idea with kind of like 2 alternates to consider. So in the near term, we surface simple logic to surface ideas that we think are a good fit for you. But what a pain. I just literally dealt with this with someone, right? Like they could refinance their debt with Upgrade or SoFi. So what they had to do this weekend was they went to Upgrade site,
Did their
go through the whole
thing?
thing, then they have to go to SoFi site, do their whole thing. And it's this hub and spoke where the person is supposed to go out and do these things. Ultimately, what we want to do is we have all of your data. We got it. You want to refinance your debt. We can let people come to you by keeping the data, and through it being anonymous, what we actually do is we assign every user a token. It's a unique ID. It's not blockchain. It's just we use tokens. And so what we ultimately want to do is take our anonymity and let people come into your data essentially as a container and bring solutions to you saying, I can make your life better by doing these things. So kind of shifting the way people consume financial services by putting it all within a plan.
Yeah, I just built the plan, which is why I asked.
While we were talking?
Yeah, while we were talking.
That easy.
It's very easy. If you know your information, right? It's
Right.
pretty simple.
Yeah.
And I built it and I was like, oh, you're right. Like I do need to do these. Maybe I should just automate my savings versus like.
How was your checklist?
It was good. You did tell me to build a will,
Mhm.
which is one, which I still don't know how, I don't even understand like
There's a lot of
wills.
online services now,
Yeah.
similar
Mhm.
ideas.
So there's an ad in there that will tell you exactly how to do your will.
Yeah, I thought it was good. So I saw that there's an ad for it. I didn't read it because I was
Yeah.
listening to you. That's
Yeah.
the truth. But the checklist was good, and I did like that you guys highlighted what I have to do because I was like, this is a lot of words, but
Yeah.
there's the highlight. So I thought it was excellent. And
Good.
Maybe it was not the plan, I promise you.
yeah, yeah.
Maybe it was,
I would say like I did resonate with you because I think that like the whole thing with like the robo advisors were like is kind of the model of like, hey, it's nothing crazy, but it's just like 2% gains across time. And if you have 25 years before you retire, it's okay. But if you have Betterment during times when like everyone's like making so much money and your friends are like, I just made so much money off of crypto and I just did this, and right? You're like, oh, what am I doing? Betterment, right? Which is like
Right.
you start to like get plagued, but then only in times like right now where everything's like tanking and the market's all up,
Right.
your friends aren't talking now, right? Like,
Right, exactly.
But your Betterment ETF is like, doing its solid thing. It's like maybe now it's at like 0.8% instead of 2%, but it's like
Right.
it's doing its solid thing. So I think that there's a lot of goes for like just some basic financial like health checkpoints that a lot of people don't even think about.
Yeah, that's what it is interesting to try to get at the complexity that the industry introduces. How do we simplify it, but then keep it sexy? I really think that combining this, and then how do we take all of the number of things you have where yes, it's highlighted and there's a list, and then how do you prioritize it to say, okay, like the one, if will is on there, then that you need a will, it probably means that you need a will.
Yeah.
So how do we get you to get that will,
Yeah.
right?
Yeah.
How do we do that? I don't know. How do I make you get a will now?
I feel like, well, I'm very young, and so the concept of will feels like something that you do when you're older.
Yeah.
So I think that the checklist is good, and I think that really just comes down to the fact that I think when people do have assets, they undervalue it, which is I think what's happening to me right in this checklist. It's like you do have assets, right?
Yep.
Even if it's not like an insane amount of money, like there's still like something there.
Right.
So it's just like, the idea of like convincing the end user that there's value to this, and if things do happen, it kind of disappears into the ether, right? And someone else has to deal with it.
Yeah.
So, I would probably say fear factors was probably going to drive people to create wills.
Yeah,
Because
and
you
if
only
you
create a
could-
will if you think you're going to
know, I
die.
could know when I was at the airport about to get on a plane,
Yep.
and it served me a pop-up that said, get a will in 3 minutes.
Right.
That would
Your
be the
basic
time.
will in 5 minutes. That would,
Yeah,
I
it's-
would, yeah, absolutely.
Yeah, I'm not afraid that I'm going to die soon, so therefore a will isn't a priority versus when you're, but you could be when you're like 65 plus, right?
Same with,
Yeah.
same with selling insurance. If you
Yeah.
could set up, if you could market to your
Not have to,
business
Right.
as they are pulling into JFK 2 hours before their flight.
Right. I really like the
You
idea.
have a very, very high.
Oh, I see you just checked out at Chipotle.
Yeah.
You may want to check out our will services.
Yeah, it's true.
Yeah.
Yeah.
How on, after your overview, there's ranges that kind of say, hey, to retire, you'll need these types of ranges. Do you like those?
Okay, hold on. I'm going to go to it if you don't mind.
It's like page 3-ish.
This interview has become a live demo.
Well,
Yeah.
it's become a lively discussion.
Exactly. It's
Fantastic.
got a combination of demo, and then we're also like challenging the business model.
It does tell me I should not own cryptocurrency and have credit and debt, which I thought was funny because I do have cryptocurrencies, and there was like, don't do it. Yeah.
But didn't say the same thing last year? When
I don't
crypto
know.
was actually a good thing?
No, it's actually, so it's looking at, well, don't go, you don't
Tell me.
have to reveal anything that's in your plan because we're in an open, so I'd love to, if you ever want to visit about it. What it does is it basically looks at different things and where you are in your life, and then it says, hey, you might want to now factor this in, but so it looks at different factors and then it says, yes, it's reasonable to consider at this point, or no, you probably shouldn't be considering it at this point. Its timing's actually been pretty good on some of those things.
Mhm.
So.
Yeah. So it does tell me that I can quit one day on my job, which is cool, but not today, which I thought was excellent.
Someday.
Yeah, wait.
Separate conversation.
Yeah.
For vested employees, they get a special plan.
I'm
I'm afraid you're not ever.
Here's on a
Yeah, I think the one thing, I probably just have to read it more
Mhm.
to understand it, like all the things, but I do think that it is very clear and easy, and it does talk about things that I never think about, which is like the basic things like life insurance,
Yeah,
which I think, I actually think you're, one thing that I realized from this is like, those who are not financially savvy do not understand any bits of the market at all, don't know where to start, like this is like an excellent place to just be like, these are just how people start.
Yep.
Right, and like how, I would also think like, like how, like people who have like, who are born in wealth already have a lot of these steps in place because they have financial advice, but people who earn wealth
yep,
don't have these
Don't.
steps, and so they don't really know like what are the basic steps before they get into
right.
direct individual investing, which they might think is the only way to be rich or, have a retirement.
Right. And actually, what we have found that's interesting, one of the things that you said was kind of inspiring me, as people are in their kind of wealth accumulation journey and then they're getting maybe closer to working with an advisor, what's interesting is to run a plan and then we've had people run plans, give it to an advisor to then debate the ideas.
Right.
Interesting.
Right? Because it sets a better table to
Mhm.
start some of the conversation, if that makes sense.
How do the advisors take that?
So we do provide we connect people to fee for service advice. Another hypothesis and kind of the longer term business model for us is we believe in a niche of fee for service advice, which is kind of like how you pay your accountant or an attorney by the hour. We think there's a lot of people that don't want to pay 2% of their assets under management to work with an advisor, or 1%, but they do want some advice sometimes, and I'm willing to spend, $100 to talk to someone for a half hour to review my plan.
Yeah.
No other commitment, just give me advice.
Makes a lot of sense.
So we're facilitating fee for service advice, and those advisors like the plan a lot because they think it will help kind of grow that space. Other advisors, it is really interesting to see. I think A tier likes it because they can see, yep, there's so much complexity for my segment of the market, it won't compete with me.
Mm.
I think some of the C tiers like, I actually just had a firm say, you actually just knocked out our value prop, right? 'Cause
Yeah.
so it's interesting, because like what does we want to charge people $1,000 for a plan, and then we want to have them implement our 50 basis point asset allocation model.
Right.
But
Yeah.
if they run your plan, they don't need to do either of those things.
Yeah.
I love like the white label model. It makes total sense. Like, and also like, I'm sure like financial advisor groups were like, 50, 60 advisors, right? They can probably
Right.
just have this.
Right.
And
But as a lead gen tool on the front end of your website. And it
Yeah.
and now I'm giving you free advice as you're kind of coming in. And then if that triggers, you want to have a question or a deeper dive, then call me and we'll talk about it. But I can give you a nice hook. Really good advisors aren't afraid of good ideas. They know that they're adding more value in more areas. It's the kind of more marginalized ones that I think are like, wow, what else do I say?
did you have to work hard to get free financialplan.com? I feel like we would have wanted that URL a long time.
I know.
Yeah. Yeah, we're really
That's
proud of having the URL, and it actually turns out that it's an easy URL to advertise. And so people like, I mean, basically you're like, okay, I like it, but I want to know what the hook is. I bet you're gonna line me up with an advisor, or I have to give an email. But if we found if you just take all those barriers, no email required, no people, free.
Look at it.
People like it, and that's if we get traffic and volume, it works out.
Yeah, makes sense.
So my question for you was, how can Vested help you? And where can we be of the most service to you?
Yeah, so I think there's a few things. So we're now at a phase where we're looking for some more earned media opportunities. And so as you guys are talking to a lot of different things, one thing that is really neat is we have a tremendous amount of data. So we would love our data to be a resource for you. I think we have the best consumer finance data that I've seen. But we asked people, are you happy? You probably didn't do the balance wheel in the process.
No,
Right?
you told me to, but I did not.
Yep, okay, so we say, are you happy? How's your love life? But the interesting thing is we can see like happiness and credit score. So the types of data that we have, I think could be really valuable to you as an agency and help us on both sides. Partnerships, different financial services firms that you're working with, the exact concept of, what if you white label this as a lead gen engine on your site? It's completely your name, your brand. They can pick and choose the ads. They're all widgets with on-off switches. So maybe they say, I don't want to feature SoFi. Great, turn off. They're all widgets. So earned media, white label partnerships, those are two really big areas, and then kind of help them convey the broader opportunity in the data set.
Great.
Yeah.
Absolutely.
I was thinking about one of our financial advisor clients who are trying to connect with their like next generation, and all the next generation conversations. Like the next generation is more tech savvy, and the old financial advisors aren't that. So I was thinking that financial advisors should be, and they also, the next generation wants like break away from their parents as advisor, right? And so this is like a great way for advisors to be like, hey, I know you want to break away, but why don't you start here and see,
Right.
make this your way to like break away. Start with the checklist. Don't break away just yet,
Right.
Which I thought would be also like a great tool
Start
to
with
start, because
checklist.
it's free and it's just like a way to be like, you're not buying from me, you're not talking to me, but I'm still like connected to your parent
Right.
somehow. Yeah. Which I
Right.
thought would be a cool way to expand.
And as you're talking through that, like what you'll find is because it is of how the questions are asked, once people start the process, it's just like how you finished it, people finish it. So then when they finish it, they get the checklist and you're like, okay, I want to read it. So it's very engaging, if that makes sense. And that's why it's a neat tool for them to use for those types of things. Like, I got it. You want to go do this other stuff? Try this.
Yeah.
And people will try it.
For sure. Very cool.
Does anybody over Zoom have any questions? We've been having a lively conversation here. Does anybody there want to join?
I know we're almost at the top of the hour.
Yes.
Some people too,
Yes.
probably.
Okay, well, thank you so much, everybody, for joining, and thank you, Tom,
Thank
for
you. I love
being
the
here
dialogue.
and
Yeah.
for answering all of our questions.
Well, we would love any ideas on feedback on plans is always welcome. Ideas on how we can kind of, partner, collaborate, use the
Yep.
data, just, consider us to be a resource. So we really look at this as a partnership.
Thank you very much.
And if anyone has any thoughts, a real quick way of conveying those over to Tom is just send me a note. And I'm very happy to pass that directly on to the Anasova team.
expecting everyone to not be doing their little.
Exactly.
Do a plan.
Financialplan.com.
Yep.
Thanks, everyone.
Hey, thanks, Tom.